In this presentation, we're going to add an amount related to draws using bank feeds. In other words, we're going to have a transaction decreasing the checking account that we have with regards to our bank feeds, which is going to be a draw from the owner. We're going to use that bank feed transaction to create the transactions in our financial statements. Here we go with Xero. Here we are in our Triple G dashboard. We're going to start off by opening up our balance sheet by going to the accounting drop down, going on down to that balance sheet. Once opened, we're going to go to the tab up top, right click on that tab up top so that we can duplicate it. So we'll duplicate that tab, then we're going to go back to the one to the left. We don't need the income statement again, so we're just going to be opening up that bank reconciliation summary report. Go into the accounting drop down, go into the reports to do so. Then we're going to be under the accounting information down below. We're looking for that bank reconciliation summary. Then once that opens up, we're going to right click on the tab up top, duplicate it as well. Then we'll go back on over to the balance sheet. We're going to change the dates. We're going to be up in April. So we're going to select the drop down, bring that on up to April 30th, and then update that report. Then we're going to go back to the reconciliation. I'm going to be picking up the checking account here, checking account. And the date, once again, in April. So I'm going to bring that on up to April. And there we have that. We will update that report as well. Back to the bank reconciliation, or the first tab, and so that we can get into the bank accounts. We're going to go to the accounting dropdown. We're going to look at the bank accounts now. And we're going to be, of course, going into those reconciling items, which we have 5 of them now. And we're going to go into that and see our reconciliation items. Going to update or zoom in a bit now, so we're going to hold down control, zoom in to the 125%. Then we're going to scroll down and let us see the draw. There's a draw. Now the draw is going to be something that is going to come out of the checking account. It's coming through the bank feed. It might be called withdrawal. It might not have any kind of transaction because it's a cash that was taken out directly by the owner. So we have the owner taking money out. We saw last time there's a question as to whether the owner takes money out. The best practice would be this. When the owner takes money out, it should only be for personal use. If it's for business use, you don't want to take the cash out. What you want to do is have the audit trail of it, because really you want to use this for taxes too. And so if there's a question about something in taxes, you'd like the audit trail. You want to know what you spent it on. And it's more information if you spend it electronically or with a credit card. So you don't really want cash transactions to track your outflows. If you're looking at it from a tax perspective, you typically want an audit trail. If you draw money out for personal use, then that's fine. And that way, every time we see money that's being taken out just for cash purposes, we would assume it to be a draw. If that's not the case, if the money was taken out for cash purposes, and we have to ask and say, well, what is that? If we're the bookkeeper and we're asking like the owner or something, what was that for? And if they say, well, I'm spending cash on this, that, and the other thing, then the question is, do we want to get receipts and kind of tie that out? Or should I just basically assume that all the draws are going to be going to miscellaneous or office supplies or something like that? And we did that last month. If that happens, then what happens is it's going to go on the income statement as an expense. And it might not be well categorized unless we have all the receipts that we're going to have to tie out, which we really don't want to do. It defeats the purpose of having the bank transfers to make this a nice, easy process if we have to then go through the receipts, right? So we're gonna do it the way we would like to see it this time, which is we're gonna assume that this draw, money being taken out of the account, was taken account by the owner for personal use, which is fine. And then we could just assume every time that money comes out as cash, just cash being taken out, is typically going to be a draw by the owner, and we'll put that to an equity account. So note, it's trying to memorize for us again. It's going to say, hey, look, last time the system's saying you put it to miscellaneous and you called it a miscellaneous expense. And that's not right this time, because we're going to say this time it's going to go to an equity account. We're changing this transaction. So we didn't make a bank rule. The system's trying to help us out here. And we're going to say, no, that's not right. And this is where these kind of suggestions on here may not always be right. If you're doing this yourself, you just kind of want to double check all the suggestions so that you don't just say okay through the whole thing and pick things up that are wrong. You want to kind of double check those. And then once you get that double check down, if you do it yourself or if you have someone else do it, I would once again recommend you make those suggestions into rules. And so you can just make a rule about it, and then the rules that are pretty solid. They should be pretty solid. And then the suggestions that further come up in the future, You can see whether they're good or not and whether you can make a rule about them or not. If you have to do things such as this and change the accounts each time, like the suggestion is coming up with something that's not quite right, then is it possible that you can make a more complex rule that might be able to distinguish when something should be, in this case, a draw versus a miscellaneous expenses? There's some way you can make a more complex rule so that it can automatically kind of pick that up. So we'll talk more about rules later, but now we're going to change this. I'm going to keep it to the miscellaneous. We could put the owner. This is really the owner that's taking the money out. And this time I'm not going to put it into the miscellaneous. We're going to put it where it should go typically when money is taken out in just cash, and that's going to be in the equity section. So within the equity section, we're going to say it's the owner's draw. We're going to say equity section, owner's draw. That's the one we want. We're going to go ahead and add this and reconcile it at the same time. So I'm going to say, okay, there we have it. Let's go to the balance sheet and see what happens. I'm going to update the balance sheet. We know, of course, it's money going out, so it's going to be decreased in the checking account. I won't go in there again. We've done that plenty of times. The other side, not to go into the income statement, but directly to the equity section, into this account called owner's capital, owner's draw. So this is the money that's coming out. So note what we have in the equity section. We've got the current year earnings. That current year earnings, if we go into the next year, will roll into the retained earnings account. Then we have the investments and the draws, which the Xero set up a separate account for. These never roll over. They never close these out. So it'll always just be there. These are always going to be the investments that you've entered over the lifetime of the company. If you always enter your investments, you putting money in, will always, just be in the equity section. And this will be draws that will always keep going in. It's never closing out to retained earnings. It's always going to be increasing. So these are the stuff that you put into the company. This is the stuff you took out of the company. These are the earnings that are currently in the current year and will roll into an account called retained earnings over the life of the company. Obviously, this amount down here too in the investments, we put a large amount in there for the beginning balance when we set up the account, which could be here or into retained earnings. No effect on the income statement because it went to draws. If we go to the bank reconciliation, once I update this number will then be tied out to what is on the balance sheet, which is the $166,599.13, and we will then no longer see the $100 for the draws. Let's go ahead and update that and see hopefully if I'm correct on that. I'm pretty confident that's going to happen. So there it is, and the 100 is now gone. So let's go back to the first tab. If we go back up top and look at the bank statement should have that $100 in there because we had that on the bank feeds, but now it's reconciled. If we go to the account transactions, now we've added an account and reconciled it at the same time for that $100. There it is. So that's going to be it for now. Let's get out of here.